Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding members of the Dividend Kings marketplace on Seeking Alpha. And what I've been doing here, I've been going through a series of articles on these high-yielding mortgage REITs. A lot of people get attracted to these things. You know, they have these double-digit yields. The one I'm covering today is AGNC Investment Corp. It was founded actually in 2008, so I'm looking at its whole life cycle here. It's currently offered at a 12.18% yield. The PE is about 7.49, or we'll call it 7.5, which is half the valuation. I would normally call that really a great valuation. However, what I think people don't understand about valuation, low valuation is only low if the business is growing. And in the long run, earnings drive market price. And mortgage REITs are not like traditional equity REITs where you measure them by FFO or funds from operations. With mortgage REITs, you measure them by earnings per share, core earnings per share. And what I want you to notice is that AGNC came out in 2008. They started out with earnings for 2009 of $4.19, and then they grew those by 88%. So you see this big surge in earnings. The white line here is dividends. And they also increased their dividend dramatically from, well, not so much dramatically, but from $5.15 to $5.60. And then they held it again at $5.60. So the company, did come out and do well. Now, if I relate that to interest rates, there's this notion that mortgage REITs do really well in rising interest rate environments and not so well in low interest rate environments. I'm not going to say I'm certain of that as a true statement, but that is what a lot of people that promote these things say. But if I look at interest rates, the 10-year note in November of 2008 was 2.25, and it rose up to 3.8. So this period of time here, roughly when this company first formed, did have a period of rising interest rates going on. But since that time, I'm measuring this by the 10-year T-bond, by the way, the interest rate has gone from 3.8 down to about 1.8 or 1.5. So it's roughly been cut. So we've had basically a sustained level of shrinking interest rates. As a result, when you look at this company, you can see that its earnings from that point forward fell from $7.89 a share all the way down to $2.35 a share, and are expected to come in at $2.01 a share this year. So what we have here is negative earnings growth. Now, I also want you to notice the white line in this graph is the dividend. The dividend followed suit almost in lockstep, went from $5.60 down to $2.16, is expected to drop to $2 for 2019 and be cut again down to $1.92 in 2020 by the consensus analysts following the company. So when I put this whole graph together here, I'm going to put earnings, dividends, and price on the graph, as well as the normal multiple. We see that the normal PE has been 720, which is, in line with what it's at currently. But here's the problem. Even though that's a normal PE, that's based on shrinking earnings. This is not a cyclical picture here. People were referring to this in the comment section of my articles as being cyclical. I don't consider this cyclical. This is a systemic, consistent, year after year drop in earnings. If I go from the period of time starting in December 31st, 2010, or the beginning of 2011, this company has cut its dividend at an average of 10.6% per year. They had several, you can see, minus 11, minus 25, minus 30. Income in 2011 would have been $1,948 on original $10,000 investment, or a yield on cost, if you will, of 19.5%. However, by 2018, that yield would have dropped to $751. Now, even though these are extraordinary yields, the fact that the yields shrink, drop to 17, 13, 9, 868, and then down to 751. That is not what the average retiree, in my experience, is looking for. But additionally, in addition to that, I do want you to notice the price. Back here in December of 2010, the stock was trading at $28.74. It's currently at $15.76. So when I look at performance again, you see that a $10,000 investment would have shrunk to $5,483. That's a negative annualized 6.7% compounded negative rate of return. I want to emphasize that. Now, it did throw off a lot of dividend income, even though it was cutting the dividend. But if you add dividends with capital depreciation here, you end up with 10,000 grew to 14,900. That's about a 4.7% rate of return, in contrast to this bull market we had where the S&P 500 actually increased by 11%. So the point is, the reason I don't consider these suitable for retirement accounts is it's not that they're cyclical. That's not the case at all. It's that this has really been a protracted period of what I would call capital destruction. Dividend income has been dropping, price has been dropping, and this is not what the average retired investor that I talk to at least wants in their portfolio. Now, there are a couple of issues. If I go back to this PE interest rate graph and I look at this period of time coming out of 2008, where, let me go back to the all graph, coming out of 2008, where interest rates were rising. So if I look at like from, I'll call it October of 2008, and let me see if I can find that real quickly for you here. So here's, well, I can go back to December of 2008. Through, I'm going to take this all the way through 2011, we see that the performance during this time was really great. During a rising interest rate environment, it did generate 30% annualized rate of returns. It did throw off a lot of dividend income. It did grow the investment by over 30% during this 2-year time frame, giving us a total annualized rate of return of 30%. But in contrast, if I measure that from that point forward over the next 8+ years, we see that we actually lost almost 45% of our growth. Our $10,000 investment again would have shrunk to $5,500. We did get some nice dividends. We got about $8,000 in dividends, but we still ended up with only about a 4% rate of return. So the point is, I don't think this is what most retired investors are looking for. They don't want an investment that pretends to give them a high yield when that yield is actually shrinking every year. So let's now compare this to a more classic dividend aristocrat like General Dynamics, which I did in the written portion of the article. The distinctions here are startling. Number one is I have a very low yield currently, about 2%. Had I bought the stock back in, if I go back to the same time frame that I measured AGNC earlier, you would see I started out with about a 2.5% yield, but that yield increased to 5.5%. My yield on cost actually grew. It threw off less dividend income, but it almost tripled my money over this time frame. And when you add dividend income in, it actually did triple my money, giving me a 12.6% rate of return, and actually outperformed the market. It outperformed it on growth, and it also outperformed it on dividend income. Now, this is what the average, in my view, at least the ones that I talk to, the average dividend growth investor is looking for. They want to see a consistent growth in the business. They want to see a consistent growth in the dividend income. And that is what I would consider to be a suitable investment for the retiree. They might not be throwing off as much cash, but they're not seeing a destruction in capital. They're actually seeing really excellent capital appreciation along the way. The next here, I'd like to take you under the hood and look at a couple of things that I think are real important. I'm going to use a bar graph here. This is common shares outstanding. One of the things I don't like about these mortgage REITs, if you noticed on the fast graph, this company only shows about 2% debt, but it is very capital needy. It needs to raise a lot of capital to buy these mortgages or invest in these mortgages. So their share count went from 15 million shares in 2008 to 441 million shares by the end of 2018. And by the June of 2019, these are quarterly data, they're up to 500 and almost 48 million shares. So it's very, very dilutive. Now, when I look at revenues, I also get a different picture. Here I want to use the line graph. Even though they're raising all this capital and diluting shareholders, revenues don't really consistently grow like you would see with a company like General Dynamics. So let's look at General Dynamics in contrast to what the picture I'm showing you here with AGNC. And what you see here is common shares have actually been decreasing since 2008. They've dropped from 399 million shares down to 299 million shares. And they've been doing that, during periods of time when the valuation on this stock was very low, if you recall. And then when I look at total revenues on this stock, we see a nice, trend line in revenues. Not, massive growth, but certainly not the cyclicality that we saw when we looked at AGNC. So the moral of the story here is I do think these consistent dividend growth stocks belong in retirement portfolios. This is now going back to the long-term picture of General Dynamics all the way to 2000. You can see how the company has consistently grown. There's weakness, periods of weakness occasionally. There's also very exciting periods of undervaluation followed by periods of overvaluation. But when this company was reduced reducing its share count, it was when the valuations were actually low. And I actually like that. I think it's okay to buy back shares when your price is low. It's not okay. In the contrast, as far as raising capital, one of the things wrong with a company like AGNC is they're raising capital at a time when they're not only is their share count increasing dramatically as a result, but they're also raising capital as their share price is falling. So I think these are high risk investments. You know, if you could figure out a way, so like some people are trying to say you can buy them when interest rates are being cut and sell them when interest rates are rising, or vice versa, I think it is. The point is that's not something the average retired investor wants. They want to buy something that they can count on, that's got high quality, that's consistent, that's going to give them a nice steady growth over time. You know, everyone takes some price volatility. If you look at that General Dynamics graph, there was a lot of price volatility, but what's not volatile and what's not falling, like we see here in this AGNC graph, is the dividends and the earnings of this company are very, very predictable and very, very consistent going forward. So anyway, I don't believe these mortgage REITs are suitable for the reasons stated above as well in the written portion. If you enjoyed this video, I ask you to go ahead and hit our subscribe button below so you can follow additional videos that we'll be producing. I want to thank you all for watching and thank you for reading the article. This is Chuck Carnevale signing out.